These are my notes for Intermediate Accounting 1, specifically in Chapter 2. We've been through the accounting cycle, but this particular video is some information, some of which we covered in class, but some of which we weren't quite able to get to, so I wanted to go ahead and make these videos available to you. I'm going to go ahead and start from the beginning of the section. It's a section of your notes that's titled The Accounting Cycle and End of Period Procedures. Again, this is from Chapter 2 in Intermediate Accounting. We start off talking about what a transaction is. A transaction is an event that's recognized in the accounting records of an enterprise. What that really means is it's going to be recorded or documented in the accounts themselves. There are certain types of events that will be important to the business but never get recorded. We've talked about this before. For instance, a major competitor moves in nearby, or a top executive comes or leaves. A number of events that are important to the functioning of the business and to its success, but never get recorded in the records of the business. There are two basic types of transactions: external events, those that involve an exchange between the enterprise and a separate economic entity. And for every external transaction, the company is receiving something in exchange for something else. There's also internal events. Internal events don't involve an exchange with outsiders, but they do affect the financial position of the company. I might add also the financial performance of the company. Examples of external events are the purchase of inventory, sale to a customer, the borrowing of cash from a bank. And so what characterizes those is you've got a transaction with an outsider. Examples of internal events are the recording of depreciation expense, or the expiration of prepaid rent, the accrual of salary or interest expenses. Part of our job as accountants is to know when an accounting event has taken place. If you think back through the whole accounting cycle that we have rehearsed a number of times, you'll recall that the first step in the accounting cycle, the accounting process, is in fact the identification of an event, to know whether a recordable event has occurred. Number two is to analyze the event, that is to determine which accounts were affected by this event and by how much, so that you've got the basis then for going on and recording that transaction. Without those first two very important steps, well, let's say nothing gets recorded, nothing correct anyway. Some events occur in ways that make it clear that a transaction has occurred, such as when a business exchanges cash for a product or a service. But some events are really less obvious, like when a business is sued or experiences a loss from flood damage, or experiences losses, say, from deterioration of inventory. These events may be overlooked. They're important, but they may be overlooked in financial reporting because they don't really involve a transaction with outsiders in many cases. They certainly don't involve an immediate outlay of cash, even though we can imagine in the future each of those events that I mentioned will raise its head, will be evidenced in the future in some way by receiving less cash than the company otherwise might, or having to pay more cash out as a result of this event. Any event that has a financial impact on the financial statements of the firm must be recorded. As a matter of fact, we said for some time now that a transaction is only going to be recorded when it affects the financial statement, specifically certain financial statement elements. And again, remember the elements that we've dealt with most over the last few weeks: assets, liabilities, equity, revenues, expenses, gains and losses. Let me give you an example. Green Mountain Coffee sells 10 shipping containers of packaged coffee to Target stores, but they consent that payment will take place within 60 days. Now, this sale is a recognized event. It would be recorded even though no cash has yet changed hands. Instead of cash, GMC holds a claim against Target for the price of the shipment, a claim that we know as an account receivable. It's important to distinguish between the events that actually happen in the business and the cash collected by the business. Events are good predictors of future cash flow, but the occurrence of an event doesn't always correspond with the collection of cash, or for that matter, the payment of cash. Let's say that 60 days after the sale, Target sends payment to GMC. Now, when this happens, the account receivable from Target is realized, that is, converted to cash by GMC. Recognition in the financial statements, that is, recording of this event, takes place before the realization, that is, the actual changing of hands of cash. By the way, these two principles, recognition and realization, we also see in federal tax. but they have somewhat of a different meaning. It's related, but it's not quite the same thing. We see a number of those things throughout federal tax. There are a lot of similarities, between what's taxable, for instance, what's income for tax purposes, and what's an expense that is deductible for tax purposes, and their counterparts in accounting. But there are enough differences there to really cause some confusion and some headaches. Now let's imagine another scenario where Sam's Club, should say Target, pays for the coffee in advance of shipment. Same sale, but now Target's paying in advance instead of after the shipment. Recognition of the sale by GMC can't occur until title to the shipment is actually transferred to Target. That is, till ownership passes, as signified by the passage of title. In other words, GMC would realize the cash from this event before it's recognized or recorded as a sale in the records. I'm having a little trouble with my. Here's what I'm using instead of a pointer. Yeah, there it is. So you can see it. So I'm having to kind of coordinate these things, and it's Friday morning. I'm not quite ready for that. Anyway, let's look at preparing and adjusting entries. I've said before, this involves what we call getting things right at the end of an accounting period. It's required by the revenue recognition principle and the expense recognition, better known as, in many circles, the matching principle. Both of those come into play. There are two basic ways to recognize revenues and expenses in accounting: the cash method and the accrual method. Under the cash method, revenues are recorded when the cash is received from the customer, and expenses are recorded when cash is paid to the supplier of goods. Under the accrual method, used by companies required to conform with GAAP, revenues are recorded when they are earned. That means that the business selling the good or service has done what is required to have a legal claim to payment by the customer. Expenses are recorded when incurred. That means that the business has consumed the benefits associated with a particular asset. And by the way, those revenues recorded when earned regardless of when the cash comes in. Expenses are recorded when incurred regardless of when the cash is paid out under the accrual basis. So very distinct differences between those two methods or ways or approaches to recognizing, that is, recording revenues and expenses. Here are some routine situations that give rise to adjusting entries. Let's consider some situations that give rise to adjusting entries. First of all is when an expense is paid before it's incurred, which results in an asset. Example, in December 2016, Chapman Management paid $24,000, which is the annual insurance premiums on some rental properties that it owns. The premiums cover the period January 1st, 2017, December 31st, 2017. So in fact, this entire premium relates to a future year. What entry would be made? Well, we generally would debit an asset account called prepaid insurance. As I've mentioned in class, it might be called prepaid insurance expense, but don't let that fool you. Prepaid changes the insurance expense from an expense into an asset. And of course, we credit cash because we're actually paying something. Number two, an expense may be incurred before the cash is paid, and this gives rise to a liability, that is, some form of payable. Example, at the end of the month, Apex Inc. received a $340 bill from the local utility for the electricity charges for that same month. The bill must be paid by the 15th of the following month, and as of month end then, Apex should make the following journal entry: to debit utilities expense and to credit accounts payable. Notice there's no cash changing hands here yet. We've just gotten the bill. The only thing we can do is to record or accrue this particular payable. A third type of event might be when revenue is received before being earned, and this results in a liability. Mud Wrestling Monthly Magazine sells annual subscriptions to its magazine for $60. In December 2016, the magazine received payments for 42 annual subscriptions, all beginning in January 2017. So it has received money for revenues that it has not yet earned in the current year. So it will have to, in the future, either give back the money, sacrifice an asset, or provide those magazines. That is, fulfill its obligation to provide subscribers with these magazines. And so that's something that characterizes a liability, present obligation of a particular economic entity to either sacrifice assets or to provide some product or service in the future. So the entry to record this event when we're receiving this amount of money, and by the way, how much is it? $360 per subscription times 42. There you have it. So we have received cash of $2,520, and we credit an account called unearned revenue, or unearned subscriptions revenue, something that whatever the company uses to describe that. But unearned revenue represents a liability. Revenue sounds like a revenue, doesn't it? But the fact that it has unearned in front of it converts that revenue into a liability. It will be earned in the future as the company fulfills its obligation to provide these magazine subscriptions. And number 4, sometimes revenue may be earned before the cash is received, and this results in an asset, specifically some form of receivable. On November 26, Bilco Designs provided architectural services for a client and billed them $5,000 for its services. This one's probably pretty straightforward for most of us. It creates a receivable. We haven't received the payment for that yet, but we have earned it. And by the accrual, under the accrual method, we will go ahead and record that revenue and show the claim on the customer for the amount that they owe us, the account receivable. Accounts receivable represent amounts customers owe us for goods and services that we have provided to them. So there are the 4 basic types of situations that give rise to adjusting entries. Now, the situations we looked at will not necessarily require adjusting entries. For instance, that very first one we looked at where the company is paying insurance premiums for a future year. They paid that premium in December of 2016, $24,000, and as of the end of 2016, that amount still pertains to the future. That is, it still represents a probable future benefit owned or controlled by a particular economic entity arising from a past transaction. So none of that premium has been consumed in 2016, so there's no adjusting entry required. That still represents an asset of $24,000. But we want to be careful about that because, as you'll see, the problems we get into will involve very often situations where there is some amount that we have to adjust for, some amount of expense to recognize, some amount of revenue to recognize. Anyway, we'll look at those right away. We've looked at some of the basic types of transactions that will give rise to or result in adjusting entries. Some of those we just looked at, in fact, are adjusting entries, like the accrual of utilities expense or the recording of utilities expense at the end of a year. You didn't have a prior entry to, let's say, to fix through that adjusting entry. But when you purchase prepaid insurance, as we did before, we'll find that we'll generally give rise to or require an adjusting entry at the end of the period in order to get things right. We'll look at those details a little, very shortly here. But I wanted to go ahead and note that there are other common adjusting entries related to things like depreciation, amortization, adjustment of accounts receivable for bad debts expense, and adjustment of inventory at year end. That is, the adjustment possibly related to loss of value, but even the necessary adjustment we need to bring a recorded inventory into line with what's actually on hand. Consider the depreciation entry. Let's say that Harris Corporation has transportation equipment with a recorded cost of $320,000. This equipment is being depreciated by the straight line method over 10 years with a $20,000 estimated salvage value. To calculate that depreciation then, we would perform a calculation similar to this. Annual depreciation expense is figured as the cost minus estimated salvage value, and that difference divided by the estimated or expected useful life. And here's the actual calculation. $320,000 minus the $20,000 salvage value divided by 10 equals $30,000 per year. You'll note, by the way, something that will come up later on, that accountants do rely on estimates from time to time. This is a key example of that. We know the cost of the asset, but salvage value is an estimate. What's this going to be worth in 10 years? You know, $20,000. That's the estimate. We know that in reality it's not likely to be that exact amount, but that's the best estimate, the best judgment we have right now. Also, the estimated useful life of 10 years. That represents an estimate. And also, to kind of throw something else in the mix, we've got this arbitrary fairly arbitrary selection of a depreciation method, that is straight line versus some version of the accelerated methods. Anyway, that's just something to look forward to in the future, and just a hint at the fact that we do rely on estimates with regard to certain assets, and we want to know what those areas are. Now, this slide shows the actual calculation of that depreciation expense of $30,000 per year. And so here's the entry that we would make as a result of that. Debit depreciation expense, $30,000. Credit accumulated depreciation equipment, $30,000. Let me note a couple of things here that we'll see later on. First of all, depreciation expense is usually not, let's say, distinguished in terms of which assets it pertains to. But the accumulated depreciation is, you might have an accumulated depreciation equipment account, accumulated depreciation buildings, accumulated depreciation land improvements, and those sorts of things. And so that accumulated depreciation account is a contra asset account we talked about in class, which is a real account but has a normal credit balance, the opposite that of the equipment. And it appears on the balance sheet because it in fact is an offset or contra account identified with equipment. In class we talked about what a contra account is. It is an account identified with another normal type of account but has the opposite balance. So just something to mention here as we in passing on this. The accumulated depreciation account, equipment account, then is incomplete as a title if you simply say accumulated depreciation, because it's got to be identified with a particular type of asset, or specifically an asset account like equipment.